Hello students, today's topic is statement of profit and loss account which all companies prepare along with the balance sheet of the company. The format of this statement is given along with the balance sheet in Schedule 3 of the Companies Act 2013. So we are going to discuss this statement of profit and loss account, how it is prepared. Let us first have a look at the pro forma of statement of profit and loss account. Look here, this is the pro forma of the statement of profit and loss account which is given in the Schedule 3 of the Companies Act. In this pro forma we write, it is written, first item is revenue from operations. Revenue from operation is the revenue of the company. Now the revenue may be a non-finance company's revenue or a finance company's revenue. If it is a finance company, its revenue will be items like interest received, items like dividend received, items like consultation of financial nature. So these items come in the revenue from operations of a finance company. And if it is a non-finance company like Tata Sons or Tata Motors, such companies, their revenue comes from sales. Main revenue comes from sales, and other small items can be there, just like sale of scrap or scrap sale. These are the revenue items of revenue from operations. Then along with this there are other incomes. The companies have major revenue from sales, but there are some minor items which are also included in other items, but that is not the business of the company. It is from sources other than the business of the company. From this profit from the sale of a machine, there is a profit. Some machine got old and obsolete and it has been sold. Once it is sold, there is an income from it. That income will be written here in other incomes. For non-finance companies, incomes from interest, etc., that also will come in other incomes. So therefore we will just total up these two and this total will come here. This is the major source of income, source of revenue for a company. The total of two types of income. One is the regular income, which is revenue from operations. The other is other incomes, which is not the regular income of a company, but it comes from sources other than the normal business of the company. So then we come to the next item is expenses. What are the expenses incurred by a company to earn this revenue? All these expenses are incurred by a company, by a business, to earn that revenue. What are those expenses? These expenses are, number one, cost of materials consumed. What is cost of material consumed? The manufacturing companies buy raw materials, and this raw material is put into the machinery, and the machinery works on the raw material, and then the finished product comes out. So this purchase of raw material, cost of raw material is calculated. How is the cost calculated? I will tell you. It is the cost of the material which has been consumed. If 5 tons of material has been consumed, that means the total material purchased during the year minus material left unconsumed. For example, 6 tons of material was purchased and 1 ton of material is not consumed. There is still stock in hand, stock of material in hand. That means the material consumed is 5 tons only. And if there is already some material is lying in the stock, then we will calculate material consumed like opening stock plus material purchased minus closing stock. What did I say? I said opening stock plus purchases of raw materials minus closing stock with the raw materials, and this will give us the figure of what is called cost of material consumed. Am I right? Now the next item is purchases of stock in trade. What is the difference between stock in trade and this? The first one is meant for manufacturing companies, and the stock in trade means the company is buying ready-made goods and it is selling them at a higher price as it is. So we have purchases of stock. This item is purchases of stock. There is no adjustment of any sort for opening or stocking here, opening or closing stocks here. Only purchases are to be mentioned here. Okay, and third item is very important. It is changes in inventories. Third item is changes in inventories. I am giving you a brief idea. I will explain it when we take an example. Changes in inventories. What does it mean? That opening stock was 5 lakhs and closing stock is 2 lakhs. What is the change? Change is that the opening stock was 5 lakhs, now it has become 2 lakhs. So what we have to note down here is that the stock has changed from 5 lakhs to 3 lakhs. Stock has changed from 5 lakhs to 3 lakhs. Right? So the opening stock was 5 lakhs and the closing stock is 3 lakhs. So we will deduct the closing stock out of the opening stock, and that is the change in the inventory. So we have to have change in inventories of 3 types. 1, change in the inventories of finished stock, change in the inventories of finished goods, then change in the inventories of work in progress, then change in the inventories of stock in trade. So we have 3 types of changes in inventories. All the 3 types will be calculated in the same way, opening stock minus closing stock. This is how we work out the changes in the. So whatever the change comes, the total of all these changes will be mentioned here. Find it? It's not individually, but the total will be mentioned here. Then we have next important item, which is the major item of expenses, that is employees benefit expenses. You see, employees benefit expenses may be of 2 types, direct expenses and indirect expenses. Finance costs. Finance costs are the costs of interest on loans, interest on debentures, interest paid on any other money borrowed from any source. Right? So these are the finance costs. Then after that we have depreciation and amortization expenses. Depreciation on machinery and amortization of intangible assets. So these will be taken up, depreciation and amortization expenses. After all these expenses, any other expenses are left out, they will be included here. Okay, after all these expenses have been recorded, we will total them up here. Then this total will be deducted out of this total. That will give us profit before tax, and this is a very detailed pro forma. And my dear students, please remember and see that this is the pro forma given in the Companies Act, but for CB.S.E 12th class syllabus it is only up to this, and this, when it is deducted out of this, you get profit before tax. This is profit before tax, that's all. Before profit before tax. All these items are not in your course. This is profit before tax. We will deduct tax here. We will deduct tax here. Then we will get what is profit after tax. So we will write the profit after tax. Now this is an introduction to the statement of profit and loss account as it is given in the Companies Act 2013, Schedule 3. But for your purpose, for 12th class purpose, the entire schedule is not in course. It has been made clear by the CB.S.E. You will be to this, and then you deduct tax, and that's all. So let me now take an example for this to explain the whole statement of fair performer once again. So my dear students, come on, one thing more I tell you. Hear this, I have noted down the entire performer as it is there in your course. This is revenue from operations, other income, that total, expenses, cost of material consumed, purchases of stock and trade, changes in inventories, 3, finished goods, work in progress, stock in trade, employees benefit expenses, finance costs, depreciation, amortization, other expenses, total of expenses, then profit is 3 minus 4. This is 3, this is minus 4, this is 4, total expenses, then profit before tax minus tax. So that is profit. This is the pro forma in your course, and this is a first part of the pro forma given in the other items are not in. Up to 4 or 5 it is there, the rest one are not there. So let me tell you one thing more. Each item, revenue from operations, will have only one item, and if anybody wants to detail, there is notes to accounts number 1. Other incomes, if you want to know the detail, go to the notes to accounts number 2. Notes to accounts for cost of material. Notes to accounts for changes in inventories, number 4. Notes to accounts for employee benefit expenses, finance cost, depreciation, amortization, other expenses. So if you want a detail, you have to go to the notes. And here I am taking an example to explain this to you. Notes to accounts. Number 1 is revenue from operations, sales. Let me say the sales are 9 lakhs. Sales are how much? 9 lakhs. Sale of scrap is 10,000. So my total is 9 lakh 10,000. This total is transferred to statement of profit and loss account. I write this total here, 9 lakh 10,000 against this. 9 lakh 10,000. 9 lakh 10,000, okay. Then number 2 is other income. Here is other incomes. Notes to accounts, other incomes. Other income include interest. Interest is 5,000. Gain on sale of machine is 25,000. So my other incomes will come 30,000. Again I write here total transfer to statement of profit and loss account. It comes 30,000 here. So this total becomes 9 lakh 40,000. Okay, so this is the total at number 3. Now I come to expenses. My first expense is cost of material consumed. So my note number 3. The notes to accounts number 3, this is number 3, that is cost of material consumed. Cost of material consumed, it is worked out A, opening stock. Opening stock of material. Say it is 1,50,000. B, add purchases of materials. They are 3 lakhs less closing stock.